Here's a debrief of drafting and interpreting financial statements, AAT Sample Assessment Task 3. So in Part A, it asks us to explain the objective of general purpose financial reporting based on the IFRS conceptual framework. 4 marks are available here, so you need to make sure that you have enough points to gather, well, at least 3 of those 4 marks to get your 70% pass. So on the screen now we're displaying the IFRS conceptual framework, and we can see in paragraph 1.2 there we have the objective of general purpose financial reporting, and the 4 marks were available for effectively memorizing this paragraph, which is available in your learning materials, and identifying the various components of this paragraph that help to explain what the purpose is all about. So we can see there it says the objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to potential investors, lenders, and other creditors in making decisions relating to providing resources to the entity. So the marking scheme provided by AAT suggests that you get marks for information about the reporting entity, existing and potential investors, lenders, other creditors, making decisions, and about providing resources. So there's more than 4 marks identified there, but you just need 4 of them to get your full marks, or 3 of them to get your pass. In Part B of the task, it asks you to identify 2 characteristics of ordinary share capital. So let's revise the idea of capital in general. So imagine if you have a sole trader, or possibly a partnership, then the owner of the business, possibly owners if it's a partnership, they put cash into the business, but the business and them, they are basically the same entity. Whereas when you have a company, it's a bit different, because you'll have the owners of the business, and again there may be 1 or more owners, and then you will have the company, and they are both separate entities. So the owners will inject capital into the business, and the company will issue them with a piece of paper, a share certificate. And that share certificate tells the owners that they have part ownership of the company. Now this is important because we want to be able to separate the company from the owners in case anything goes wrong. Imagine with our sole trader and partnership, if anything goes wrong with their business, because the business and the owners are the same entity, if anything goes wrong, then the owners may have to sell their homes just to raise enough money to pay off any debts that they have. Whereas with a company, this is a separate legal entity, and therefore if there's a problem in the company, then third parties may want to sue the company, and perhaps the company may be forced into bankruptcy. But because the company is a separate entity to the owners are protected. They don't have to sell their personal assets just to be able to pay for the debts of the business. All they would lose would be the value of their share certificate. In terms of monetary amounts, let's suppose they spent £1 to buy that share certificate, so effectively they'd only lose the £1. They wouldn't lose anything extra on top of that £1. Whereas in the sole trader, they would lose a lot more because they'd have to pay the complete debts of the business. There could be many owners of a company, and they're all called shareholders. They'll all be injecting capital into the company, but they may all pay different amounts of money. The piece of paper, the share certificate, will have a nominal or sometimes it's called a par or face value. And let's suppose that could be £1. But it could be anything that's the company decides. It could be 10 pence, 50 pence, but in many cases it's going to be £1. So each of the shareholders will want to buy a number of these share certificates, but they won't necessarily pay the £1 though. It could be that the company is very successful and it may have, let's say, a market value of £3. So it could be that the company will ask the shareholders to pay £3 to buy one share rather than the £1 nominal value. And that's perfectly fine. When the shareholders pay their money into the company, so here's the double entry, we would debit bank with the £3, the amount that's actually paid by the shareholder. We would credit share capital with £1. So it's important to recognise that in the accounts, the share capital is always valued at the nominal value. And then the extra that's been paid in is the share premium of £2. And this needs to be shown separately in the statement of financial position because by law there is a limit on how that £2 can be used. Share premium is a special type of equity reserve and the Companies Act restricts how it can be utilised in the accounts. Both the share capital and share premium would be shown in the equity area of the financial statements, in the statement of financial position. As the owners of the business, the shareholders are allowed to make certain decisions about how the company is run, although the decisions are really made by the directors of the company rather than the shareholders. So shareholder power is really quite weak in comparison with director power. It could be, however, in small companies, the shareholders and directors are the same people. When the shareholders are making decisions on things at the general meetings, they will have a number of votes depending on how many shares they have and the proportion of the share capital that they own. This proportion will depend on the nominal value rather than how much people actually paid for the shares. Because you can imagine that over time the market value may be going up. So depending on when people actually buy their shares, it could be that you pay a lot more later on into a company's life than earlier on in the life to buy the shares. But the voting power will depend on how many shares they have rather than how much they paid. Over time, we'd expect the company to grow as it earns some profits and is successful. And as it earns those profits, then we would expect the shareholders to benefit from those profits as well. And therefore, the company will pay to the shareholders a dividend. Dividends are at the discretion of the directors. The shareholders may not demand dividends. So the directors may pay a dividend either as a fixed amount per person or as a fixed amount in total that is shared between the shareholders, or possibly as a percentage of the nominal value that the shares are worth. So it really depends on how well the company does, and that's how much the dividends will be. Some companies choose not to pay dividends. So for example, if you look at the history of Microsoft, they very rarely pay dividends because they've wanted to retain the cash in their business so they can invest in growing the business instead. If that's the case, the sort of shareholders who might invest in Microsoft are those who want to buy the shares at a low price and generate their wealth by selling them later on at a higher price instead of earning some sort of regular income from dividends. At the end of a company's existence, we would then need to sell off all the assets, pay off all the liabilities, and then any money left over is then paid on to the shareholders. So this revision session is probably a bit long for the 2 marks that are actually available for describing the ordinary share capital, but hopefully it's been a useful recap. Finally, in part C of the question, it asks us to identify whether each of the following qualitative characteristics of useful information is a fundamental characteristic or an enhancing characteristic based on the IFRS conceptual framework. So we're looking in particular at verifiability and relevance. So here's the framework again, and we're looking first of all at the fundamental qualitative characteristics, and we can see that relevance is one of the fundamental characteristics. So if we scroll down and have a look for verifiability, so here are the enhancing qualitative characteristics, and we can see that verifiability is one of those.